Don't be afraid of recessions. The US has seen 48 recessions since the 1700s and 14 over the last 100 years since the Great Depression. The one during the Great Depression was the longest, and it lasted for 3 years and 7 months. The shortest one lasted just 2 months. Do you know which one it was? It was the COVID recession that went from February to April of 2020. And guess what? Every recession was followed by a recovery. In this video, I'm going to talk about stock market crashes and recoveries, and also how you can get 15 free stocks. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder, and I've helped dozens of women take control of their financial futures. Subscribe to my YouTube channel and follow my Facebook page to watch all my latest videos on building your own wealth through investing. A lot of people are worried about a recession, and that is one of the main reasons holding them back from investing in the stock market. In this video, I'm going to walk you through recessions and how recessions have affected the US stock market. I'm also going to talk about some biases in investing and how they can affect your investment returns. If you don't have a brokerage account or have one but want to get 15 free stocks, stay till the end. I will tell you how to get free stocks. This is the S&P 500 index since the Great Depression. If you don't know what an index is, go watch this video where I discuss this in detail. The gray bars on the S&P chart show all the recessions. Like I said, there have been 14 recessions. The wider the bar, the longer the recession lasted. If you look closely, you can tell that the COVID recession was the shortest in history. Let me zoom into a more recent period. Same chart, but here the starting point is 1990 instead of 1929. That's the last 32 years. The US has seen 4 recessions during those years. The stock market really took off during the dot-com bubble in the late 1990s. In February 1998, the S&P 500 closed above 1,000 for the first time. There were a ton of tech entrepreneurs producing cool stuff. The interest rates were so low that entrepreneurs were able to borrow money to grow at low costs. Anything tech, and people wanted in. They didn't care about valuations. Remember intrinsic value? Go watch this video if you missed the discussion. During the dot-com bubble, investors kept buying tech stocks. Buy. There was euphoria. The high demand for tech stocks caused a big rally in the market. The stock market peaked at 1527 on March 24, 2000. Then it all came crashing down when the dot-com bubble burst. One of the triggers? An increase in interest rates. Over the next 2.5 years, the market fell by almost 50% from its peak. And it took another 4.5 years to recover all that value lost from its peak from March 2000. But recover it did. So, in May of 2007, it was back at its previous peak, and it took a total of 7 years from this high point to get back to the same level. And guess what happened next? A few months later, the market peaked again at 1567 in October of 2007. That's when we saw another recession, the Great Financial Crisis, or the GFC, that followed after this peak. This time, the trigger was the housing bubble caused by some very unscrupulous people driven by greed. During the GFC, the market lost 57% of its value over a year and a half, but the market recovered again. This time it took 4 years to come back to its previous peak. It took a total of 5.5 years from this high point to get back to the same level. From this low point here, the market just rallied for 11 years. There were occasional dips. Then came COVID. The market peaked at 33.86 in February of 2020, only to lose 34% over 1 month in March of 2020. The market quickly recovered after that in about 6 months. I've spoken to a few people who are scared to invest. What if I had invested at this peak, they ask. And my counter argument for that is that the market recovered eventually, didn't it? It took a few years, yes, but investing is a long-term game. You are in it to build lasting wealth, not to make a quick buck, which is why you have to play it smart. Don't invest your money all at once. You are not at a casino. You can employ simple strategies such as dollar cost averaging. Keep a solid emergency fund so you don't have to worry about cashing out your investments in case of an emergency when the market is at a low point. Remember that instead of investing, if you just kept your money in a savings account, you are losing money to inflation because your buying power is going down every day that you stay in cash. Recessions will come and go. They present opportunities to generate wealth, but they are also hard to predict. Economists use some indicators such as the yield curve to make forecasts. But that's that. They are just forecasts, and oftentimes they're wrong. There is a running joke that there are two types of forecasters: those who don't know and those who don't know they don't know. So don't try to time the market. Use a disciplined approach to investing. There are parameters beyond anyone's control that can cause markets to crash. Now, there are some parameters that are in your control. But before I talk about what they are, please show me some love by smashing that like button. You'd be doing me a big favor. And if you haven't already, please hit the subscribe button and click on the bell icon to get access to my latest videos. If you're watching me on Facebook, don't forget to follow my page. Please comment below what you like and what you want to hear more about in my future videos. I've also linked my budgeting worksheet and my investment plan template to help you create your own investment plan. And here's a video that explains how you can build your own investment plan. We are all human and carry a lot of emotional baggage and biases. Even you, Sandra. It's important to know what those are and how they manifest in our investing decisions. The first one is confirmation bias. When we like a particular stock, let's say Apple, we will actively seek out information that will support our liking for Apple and ignore any contrary information that comes our way. Remember that girl that you dated in college? All your friends pointed out that she was weird, but you were so in love that you ignored all that information until she went all psycho on you. If you pick a stock to invest, don't stop asking questions. Challenge your own hypothesis and analyze information objectively to avoid confirmation bias. Another one is loss aversion. People have a strong preference to avoid a loss rather than to earn a profit. So they tend to hold on to losing positions and sell winners early. And I'm guilty of this one. Let's say, for example, you bought shares of Carnival, the cruise company, right before the pandemic hit. And then the stock went downhill from there. If you kept clinging on to your Carnival shares because you didn't want to lock in your loss, that's loss aversion. You need to consider the opportunity cost. If you sold your shares at a loss, you could use your funds from the sale to buy a stock that was more attractive and could potentially have generated a profit that could have offset your loss. Another bias is groupthink. This one leads to some catastrophic losses. Think about the crypto mania and how that played out. A small group of people started buying crypto. The information spread and retail investors started buying cryptocurrencies without any information, just based on market noise. These trades can lead to some pretty big movements in prices, which are often unsustainable. Always come up with your own independent thesis for investing in anything that's not the broad market, like an index fund. Don't rely on groupthink. No investing because your smart brother-in-law thinks this is a great investment. Do your own research. Another one is familiarity bias. This can lead to a lack of diversification. For example, if you work in healthcare, you may be more familiar with companies within your own industry. And because you understand the healthcare industry better than any other, you may be more inclined to invest in health-related stocks at the expense of not diversifying your portfolio. That's when your portfolio will be less diversified, and it can cause two problems if your industry suffers. First, you may see the value of your own portfolio go down if your industry is in a slowdown. And second, there may be a higher probability in case your industry is going through mass layoffs. If you are the one to lose your job, you lose your income as well. So it's a double whammy on your income and assets. The next one is overconfidence bias. When the market is booming, as it was from 2010 to 2020, a typical portfolio will generate positive returns. And as your assets grow, it can lead to overconfidence and self-attribution, in turn leading to some very risky bets. It's good to be aware of all these biases when it comes to investing. It will help you stay grounded and avoid mistakes. Now let's see how you can get your 15 free stocks. There are many factors you should consider before opening a brokerage account, the most important being cost. Check the types of securities you will be trading in your account and the fees the brokerage charges for those types of securities. I talked about brokerages in this video. Other factors to consider are access to research, availability of fractional shares, especially if you are new to investing and want to start small, brokerage app features, and so on. Moomoo is a relatively new broker, and when you use my affiliate link in the description to sign up, you can receive up to 15 free stocks. And for a limited time, Moomoo is offering a $10 cash bonus after you open an account and deposit at least $1 in it. The one thing I did while signing up is that I didn't authorize my bank to share all my details with the app. Instead, I linked one single account for money transfers into and out of Moomoo. I highly recommend signing up with Moomoo to get those 15 free stocks and the cash bonus. I think it is available until December of this year. Whether you decide to go with Moomoo or another brokerage, the process of opening an account is very simple. It's mostly online and you need to provide basic information such as name, social, sometimes driver's license. Moomoo didn't require the license information, net worth, and so on. You also need to link your bank account so you can transfer money into the brokerage. Once you open the account, you can transfer the necessary amount into the brokerage and start buying stocks and ETFs, but not before you do a thorough research. That brings us to the end of this course on stock market for beginners. Here's the next video I want you to watch. And stay tuned for my other videos. Make sure you're subscribed to my channel. Even though I'm on Facebook, YouTube is where I post my video first. As always, don't forget to be happy, to be kind, and to be your best self. Bye.